There is only one guarantee I can give you in this business, and it is this. If you can't stick to the rules you develop, and if you are always finding some excuse to enter or exit a trade earlier or later than your rules state, you will never, never make it as a trader. What if each time I bought the mini-sized Dow, my trading execution platform knew I would be using a 20-point stop and a 10-point target on the first half of my position? If it knew that, then it could place the orders for me automatically and I wouldn't have to do a thing. What if it also knew that when my first target was hit, I wanted to bring my stop up to break even? And it also knew to change the number of contracts in my stop from 10 to 5 when the first target was hit? What if it also knew to then trail the stop? What if I had a target and it knew to cancel my stop order once my target was hit? All automatically. So all I had to do was get into the trade, and after that I could essentially walk away because the software was managing the trade for me according to my specifications. The purpose of my day would be to sit back, relax, and focus on finding high probability entries instead of having to scramble around once I'm in the trade and actively manage it, a process that can be mentally straining and cause many emotional fluctuations. That is the kind of software that is available today. All traders have to do is wait and be patient for an appropriate entry level, take the entry, and then the software can manage the trade for them according to their own specifications. This process removes a lot of the mental stress involved in trading and helps to prevent traders from making the common mistakes that ruin many of them. So it took me a while to finally venture into these markets. This isn't so much the case today because these markets have become more accessible. Ironically, however, some of these same institutional traders now visit me at my offices to learn the various trade setups I utilize in these markets. They had no problem trading these instruments with the firm's money, but when they left to try it with their own money, the psychological factors kicked in and they struggled. I eventually worked with some traders in these markets in the mid-1990s, and they helped to strip away the myths, showing me how these markets worked and how to reduce risk and create solid trading opportunities. In my search to understand the futures and forex markets, I had to pull bits and pieces together over the course of several months from different sources to finally understand how all these trading instruments worked. Most of the information was elusive at best. A more apt description would be worthless. I never was able to find a consistent, easy-to-understand summary that told me all I needed to know about trading these instruments, and this process was frankly frustrating and annoying. As a trader, I just want to know the basics. How do I trade them? How much money do I need to trade them? And how does the price movement affect my P&L? I'll use the rest of this chapter to create the summary information I wish I'd had then. In the end, I'm glad I tried these other markets out, as it is these other markets that allowed me to make the jump to trading full-time for a living. Futures 101. Think of this as a quick blurb designed to help a trader better understand the futures markets. This account is by no means comprehensive. There are entire books written on the subject. However, to an individual who has traded only stocks, the futures markets are probably a mystery and maybe even a little menacing. Yet traders who have already learned the importance of strict money management will appreciate what futures trading has to offer. Typically, once people try trading futures, they simply stop trading stocks. The ease of entry on both the long and the short sides, ability to focus on a few markets instead of hundreds of stocks, and the lack of market maker games makes them a refreshing change from the world of stocks. Let's begin. First off, there are many types of futures contracts. A person can trade anything from copper to coffee, from stock indexes to silver, or from pork bellies to palladium. It's not important to worry about most of these contracts in the beginning, but it is important to understand a core group of these contracts and how they work. I know many traders who focus only on one of these contracts and are doing quite well. However, it took them time to find the right market and the right setup within that market that was best suited to their personality. This can be an often long and perilous journey, but once they found the right fit, they never looked back. If traders say they just made 50 points in the YM mini-sized Dow, that is just like making 5 points in the ES, E-mini S&Ps. It is imperative that traders know their stop before they enter the trade, and that they stick to it and not play any psychological games. In futures, as in stocks, hoping and praying can and does lead to ruin. However, the nice thing about futures is that they are so quick and the fills so clean that a trader can get stopped out and then a few moments later get right back in. A trader can't be afraid to take small losses, period. Re-entry is only a commission away. In addition, electronic contracts were set up specifically for traders. They are super liquid and fills are instantaneous. There are no market maker games such as those that happen daily with individual stocks. And with electronic contracts, a trader is out of the pit, where outsiders can sometimes be treated little better than a cockroach. Here are a few other things I like about futures. If traders think the market is going to break out, they can buy a stock like INTC, Intel Corp, and watch it sit there while the market roars on without them. They were right on the market, but their stock pick didn't move with the market. With the stock index futures, a person is trading the market instead of watching the market. It is what it is. A trader can short on a downtick. This makes a huge difference in trying to get filled during a breakdown. After trading futures, I stopped trading OEX options. The spreads and premium of OEX options now look ridiculous. Where else can a person be dead right on an intraday move and still lose money? The OEX options market. Although I do use OEX options for swing trading, I wouldn't day trade them with my mother-in-law's trading account. Not when the mini-sized Dow and E-mini S&P futures are so clean and efficient. A person can do most of his trades at the market and get good fills, unlike stocks and especially unlike options. For stocks, a person needs $25,000 to day trade. For futures, a trader can open an account with $5,000 or less and day trade. There are no day trading rules or classifications. That said, I recommend that people start with a larger-sized trading account, but I also realize that everyone has to start somewhere. My first trading account was $2,000. Can people quit their job and open a futures account with $5,000 and trade for a living? Absolutely not. I talk more about this later. I typically trade one contract for every $10,000 to $15,000 that is in my account. This way, the account swings will not be as severe, and I can trade with a level head. One trader friend of mine trades one contract for every $50,000 in his account. He makes money and is never stressed out. Conversely, I've seen programs that say to take a $5,000 account and trade 5 contracts, and by doing this, a trader can make 6 figures a year. This is insane, and traders would be better off donating that $5,000 to charity because they will lose it all trading it that way. There are few guarantees in the futures industry, but losing all of your money trading with this much maxed out margin is the one sure bet available today. With futures, at the end of the year, traders don't have to list each individual futures trade like they would have to do with stocks for their tax return. They get a 1099 form from their broker with their total profit or loss for the year. All they have to put on their tax return is that number on the 1099. That is much easier and much less time-consuming than listing every trade. Tax treatment is also favorable. For stocks, a trader has to hold them over a year to get classified at the cheaper long-term gain rate. For futures, a trader gets a 1099 that says, for example, $20,000 in gains for the year. Of this, 60% of the money is treated as long-term gains, lower tax rate, and 40% at the short-term rate. This is the 60-40 rule. This rule holds true even if you go flat at the end of every trading day. This applies to all futures contracts except single stock futures, which are treated as stocks in this regard. Buying a mini-sized Dow contract is just like buying IBM, International Business Machines, or GOOG, Google, in terms of mechanics. I also recommend starting off trading one lot at a time. A new futures trader will make mistakes, and a mistake on one lot is much cheaper than a mistake on 10 lots or more. A trader who has never used a futures broker before should talk with other traders to check out rates, levels of service, and so forth. On the web, you can check www.razorfutures.com for a list of different trading platforms and execution systems. Chapter 7. Pivot points, great for trending days and even better for choppy days. One of the simplest and most effective position entry techniques I use is based on what I call the multi-pivot levels. This is a setup that can be used on a variety of markets, though I typically use them on the mini-sized Dow, YM, E-mini S&P, ES, E-mini NASDAQ, NQ, and E-mini Russell, ER, futures contracts, as well as some individual stocks. They can also be used on the corresponding stock index ETF via the DIA, diamonds, SPY, spiders, QQQQ, the Qs, and IWM. The main advantage of this system is that it is price-based as opposed to indicator-based. By the time most indicators generate a buy or a sell signal, the move is already well underway. By following this price-based methodology, I will get into a trade before the indicator-based traders, and I usually end up handing off my position soon after a buy or sell signal is being generated on a stochastic or other oscillator type of system. This is especially true on choppy days. Just as the Johnny-come-latelys are jumping in, I'm closing out my position and looking for the next setup. On choppy days, it's the indicator-based traders who get taken out back and shot. Their buy signals get them in at the top of the move, and their sell signals get them in at the dead lows, leading to a frustrating day with a negative P&L. Pivots are set up to naturally take advantage of their mistakes, essentially siphoning money from these trading accounts into your own. This is also a good system for traders who don't have time to stare at the charts all day long, or, not surprisingly, for traders who have a bad habit of chasing the market higher and lower. Playing the pivots automatically creates trader discipline, because the entries and exits are determined before the trading day even starts. The other thing I like about the pivots is that they can be used as a tool to quickly determine what kind of trading day it's going to be. On a trending day, markets will move to a pivot level, consolidate for 15 to 20 minutes, and then continue to march in the direction of the trend. On these days, I wait for the move through the pivot level and then buy the first pullback to that level. On choppy days, however, the markets will move up to a pivot level, hang around for a short time, and then drift back in the direction from whence they came. Many traders get chopped up during these types of trading days, losing money and making their brokers rich in the process. The pivots are naturally set up to be faded on these days and are one of the few profitable ways to trade the low-volume, narrow-range chop. There are two very easy ways to tell if the market is trending or chopping. The first is to look at how the markets react to the pivot levels once they reach them. The second is to set up a 5-minute chart of the E-mini S&Ps and see what kind of volume is coming into the market after 10 a.m. Eastern. If the volume is over 10,000 contracts on each bar, then the market has power and volatility behind it. These types of days usually have wide ranges and strong trends. However, if the volume after 10 a.m. Eastern is consistently below 10,000 contracts on a 5-minute chart, then there is little power to move the beast, and the end result will be a slow, choppy day. On the first type of day, I wait for the markets to move through pivot levels, and then I set up an order to get in on the first retracement. On the choppy days, I place open buy and sell orders against the pivots and have standing orders to fade these moves throughout the day. There is nothing to watch on these types of days, so I generally let my orders do the work for me while I spend some quality time at the driving range. So what exactly are the pivots? There is no big mystery or secret to them, and many readers will have heard about them and have used them in their own trading on a regular basis. Pivots are readily available and have been around for a long time. They are support and resistance levels calculated by floor traders using a simple mathematical formula. These levels became widely known and have moved off the floor. Today, many traders are aware of them and try to use them, but in my experience, they are using them incorrectly. Chapter 9. Tick Fades, Taking the Opposite Side of the Newbies. The markets spend the majority of their time backing and filling. That is, they drift up to a resistance level, then turn around and drift back to a level of support, not really doing much of anything. For most of this time, there isn't much for a trader to do except wait, and that usually involves extreme patience. Many traders fail in this regard. After all, they are traders, right? They should be taking a trade or managing a trade, not just sitting around doing nothing. This is and will always be one of the biggest misconceptions about trading, the thought that a trader has to be in a trade nearly every minute or every hour of the day. In reality, there are always 3 positions traders can be in at any given time. They can be long, short, or flat. Being flat, meaning not having any trades on, is the best course of action 60% of the time. Cats don't chase the first bird they see. They crouch and wait, sometimes for hours, for the right time to pounce. And so it should be for the active trader. When something interesting actually does happen, such as a buy or sell program hitting the markets, this creates a great scalping opportunity for the alert trader. The key for traders is to be patient, sit on their hands, and wait for these moments to occur. There is no easier way to do this than watching the ticks, or I should say, listening for the ticks. When the ticks get over plus 1,000 or under minus 1,000, this represents extreme buying or selling, and at this stage of the move, most of the bullets have already been fired. Many amateur traders get caught up in the froth and excitement, get scared that they are missing out on a big move, and jump on board in the direction of the move, just as it is starting to peter out. These are the bag holders that will get shaken out on the reversal. Rather than join in on the move, I like to wait until the extreme tick reading is registered and then fade the move. Earlier I mentioned that I like to listen for the ticks. By this I mean that I set up audio signals to alert me when these levels are hit. This way I don't have to stare at the charts and potentially miss a move if I'm not paying attention. I can be down the hall, hear the alert, and know exactly what is going on. Getting down to specifics, whenever I see or hear readings of over plus 1,000 or under minus 1,000 ticks, I fade the move by placing a market order. If we get a plus 1,000 tick reading and I am flat, I short the move at the market. If I am already long based on another signal, I start exiting that move and initiating a short position. The reverse is also true. If the markets are selling off and traders are jumping in on the move down to the point where the tick reading of minus 1,000 is registered, I want to step in and buy. There isn't any cleaner way to get on the opposite side of amateur traders chasing the market. I've been shown a couple of different renditions of this setup by other traders. The ticks have been around for a long time, and many people who have been doing this for decades have a portion of their trading tied into the ticks. Trading rules for sell fades. Buys are reversed. 1. I have studied 3 different setups that I have learned from other traders and have modified them to fit my own trading plan and style. Let's look at the parameters I use for this extreme emotion play. I take trades only between 10 a.m. to 3:30 p.m. Eastern. A lot of sporadic action can happen during the first and last half hour of trading. I like to let the markets settle in before taking trades. 2. I play tick fades in 2 markets, the E-mini S&Ps, ES, and the mini-sized Dow, YM. These can also be played in the Spiders, Diamonds, E-mini Russell, E-mini NASDAQ, and any stocks that are mirroring the action of these indexes. 3. When the ticks reach plus 1,000, I short at the market. I like to set audio alerts for plus 1,000 and minus 1,000 readings. That way I don't have to stare at the chart. If the ticks get to plus 988 and fall back, I don't take the trade because I won't hear my audio alert. This keeps the setup clean and very specific, and not subject to trader interpretation. 4. For the YM, I use a 30-point stop and a 20-point target. I also set a time limit on this trade of 35 minutes. If my stop or target isn't hit within the 35-minute time span, then I exit my position at the market. I like to use a timer with a beep so I'm aware of when the 35-minute time limit has passed. Most traders have very little sense of time when they're in a trade. 5. For the ES, I use a 3-point stop and a 2-point target, as well as the same time limit. 6. If I am stopped out twice in a row on this trade, I am done with the tick fades for the day. By stopped out, I mean if my physical hard stop is hit, as opposed to the time stop. 7. If by 12 noon Eastern the ticks have spent over 85% of their time above zero, I will pass on all other tick plays for the day. This shows an extreme level of buying in the market, indicating that funds are accumulating stocks. These power days are rare, but they do happen about once every 4 to 6 weeks. They are accompanied by many extreme tick readings above 1,000, typically between 1,200 to 1,400 ticks. In addition, if it is past 10 a.m. Eastern and the ticks have all been one-sided, for example, all positive on the day, I will wait until the ticks have spent some time in negative territory before setting up the first tick fade play. Summing up the tick fades. The financial markets are naturally set up to take advantage of and prey upon human nature. When traders see a market running away without them, their natural instinct is to jump on board and participate in the run. Although this makes sense on paper, this feeling of missing the move causes more trading errors than almost anything else. This blinding urge forces amateur traders to jump into markets based solely on the fear that they are missing out on a lot of profits, as opposed to entering the market as a result of a specific setup that they have mapped out and are patiently awaiting to set up. This extreme panic buying and selling is measured accurately by the ticks, and extreme tick readings provide traders with the opportunity to jump into the markets and teach the amateurs a valuable lesson. Redefining volatility. How narrow is narrow? The squeeze takes advantage of quiet periods in the market when the volatility has decreased significantly and the market is building up energy for its next major move, higher or lower. This indicator was introduced to me by my trading partner, Hubert Centers, and it has become an integral part of my own trading plan. For students of the Bollinger Bands, periods of low volatility are identified as the times when the bands move closer together. This is always great in hindsight, but in real time, how does a trader know that the current narrowness is really narrow enough to qualify as low volatility? This setup answers that question by adding the Keltner channels as well as a momentum index oscillator. For readers who are unaware of how these indicators work, I'll take a few moments to explain them here. Bollinger Bands are a type of envelope that is plotted at standard deviation levels above and below a moving average. This produces an effect of having the bands widen during periods of higher volatility and contract during less volatile periods. During periods of lower volatility in sideways moving markets, the bands contract toward the moving average. Keltner channels are based on a standard moving average. The actual band lines are offset by a positive and negative standard deviation value from the central moving average value to provide upper and lower bands. While the Bollinger Bands expand and contract as the markets alter between periods of high and low volatility, the Keltner channels stay in more of a steady range. The momentum index oscillator is used to estimate the direction, velocity, and turning points of market movements. Make sense? If not, that's fine. I don't understand how electricity works, but I know when I plug my computer into an electric outlet, it will turn on. Now, let's look at how I use all this for a setup. The quiet periods I'm looking for are identified when the Bollinger Bands narrow in width to the point that they are actually trading inside of the Keltner channels. This marks a period of reduced volatility and signals that the market is taking a significant breather, building up steam for its next move. The trade signal occurs when the Bollinger Bands then move back outside the Keltner channels. I use a 12-period momentum index oscillator to determine whether to go long or short. If the oscillator is above zero when this happens, I go long. If it is below zero, I go short. These are all canned studies that come with most charting packages. For the parameters, I just use the default settings on TradeStation. These readings are 20 and 1.5 for the Keltner channels and 20 and 2 for the Bollinger Bands. My partner Hubert also took an extra step and turned all these into an indicator, which makes it easier to read on the chart. Chapter 11. Brick Plays. Letting the Markets Stack Up. My trading partner Hubert Centers uses the brick play every day, and he uses it exclusively on the mini-sized Dow. He was very helpful in sending me chart examples of brick plays that he had taken while I was working on this part of the book. The best intraday trades take place when a trader is able to catch the major portion of an intraday reversal. One of the best ways to do this is with a specific price pattern that we call bricks. We call them bricks because the price pattern that is formed looks like a bunch of building blocks that have been placed on top of a regular bar chart. These building blocks are formed on the chart because of specific price action. A series of 3 consecutive higher closes will form an up brick, and a series of 3 consecutive lower closes will form a down brick. If you have a hard time pulling the trigger, this is a good play to use with buy stop and sell stop orders, as you will see in a moment. If you don't have a hard time pulling the trigger, then you can just wait for the signal and go in at the market. This is one of those plays that is difficult to explain, but easy to show. In this case, a picture is worth at least 1,000 words, if not more. So let's go through the trading rules. Trading rules for buys. Sells are reversed. This is a momentum reversal confirmation play. 1. Set up a 24-hour time frame on an intraday chart so that the overnight activity can be accounted for in this indicator setup. This is best used on smaller time frames, typically under 5 minutes, though it can also be used for swing plays on daily charts. 2. Once a market shifts direction, which is denoted by the bricks changing color, count backwards to the 3rd brick in the formation. 3. Then draw a horizontal line across the top of this 3rd brick back. 4. Once the price action breaks above this horizontal line, go long. 5. Hubert and I use this setup on the mini-sized Dow, and we both manage this trade differently, so I will go over both of our methods. For Hubert, he places a 10-point stop from the entry. Then, when he is up 10 points, he sells half his position and moves his stop to break even -3. So, if his entry was 105.45, then his new stop is 105.42. If the market goes up another 10 points, he sells a quarter of his position and then moves up his stop 6 points to break even +3. So if his original entry was 105.45, his new stop is 105.48. He then hangs on to his last quarter of the position to exit at his discretion. This typically means that he will hold on to this last part of his position until the bricks signal an opposing sell signal. 6. I will get into the same trade and use a 20-point stop. I will exit half my position at +15 points and then stay in the trade until there is a brick that is formed in the opposite direction, an opposing sell signal. I don't trail the stops. Both methods have worked well for us, and this is a good example of how different traders can take the same setup and modify the trading methodology to fit their own particular personality. The brick setup is great when you're trying to catch an intraday reversal. Too many traders try to do this but end up getting burned. They short the market and it just keeps going higher. Or they buy the market and it gets flattened. There is no reason to try to catch the exact high or the exact low in a market move. That involves too much risk and has a low probability of success. With this confirmation signal, a trader will be made aware of when the move has petered out and has started its reversal. And although they won't be able to catch the exact highs or the exact lows, they will still be able to catch the meat of the move. What are my drawdown rules? If I am down by 15% for the month, I will cut my position size in half for the rest of the month. If I am down by 20% for the month, I will stop trading the rest of the month. If I hit a 30% total drawdown, it is time for a 6-week break from trading. My daily drawdown max for intraday trading is $3,000 per $100,000. If at the end of the day I exceed this level, I am on probation the next day. If I exceed $3,000 per $100,000 again that week, I am done for the rest of the week. This is my punishment for breaking my trading rules. I have to point out that many hedge funds and money managers are much more conservative when it comes to drawdowns and annual targets. A monthly drawdown of over 5% for a hedge fund can be devastating to its business, and an annual gain of 20% year after year opens the floodgates to billions and billions of dollars for any fund. I have a couple of comments on that. First off, the day trading strategies discussed in this book are not going to work on a $400 million fund. There is nowhere near enough liquidity to get in and out of the markets with that much money in that short a time frame. Many funds, however, will allocate a portion of their $400 million to take advantage of intraday trading opportunities I described in this book. Out of $400 million, how much would they allocate? Maybe $1 million. That is 1/4% of the entire fund. I bring this up because people need to treat their trading account for what it is, a high-risk way to make a living. Most of a trader's funds should be kept in conservative vehicles, things like bonds or funds run by conservative money managers. Only a portion of total funds should be allocated to an aggressive trading account designed to generate monthly income. What are my profit rules? My target daily average goal for intraday trading is $500 per day per $100,000. This is conservative and achievable, and it adds up quickly. I will focus on generating 5 $2,000 per $100,000 days per month. This means I don't have to trade every day. I know from past experience that my best trading days are Tuesday, Wednesday, and Thursday. Therefore, I will focus more on trading these days. If I am up over $2,000 per $100,000 before noon, I will continue to trade until I have a losing trade, at which point I will stop for the day. If I have a day in which I make $5,000 per $100,000, I will take the next day off to escape those feelings of euphoria that cause traders to do stupid things like double up on positions or trade without a stop. I will stop trading for the rest of the month at $20,000 per $100,000. I will track my daily equity curve through using an Excel spreadsheet. I will withdraw 50% of my trading profits at the end of each quarter. I will never add money to an account that is down, and I will never meet a margin call. I will add money to an account that has proved itself with positive returns. The reason I will withdraw profits is because this is the best way to protect them. It is with these profits that I get to invest in more real estate, buy more gold coins, pay for a family vacation, and fund my projects. It also is a reminder that the numbers on the screen are real and represent real cash. Concluding thoughts on my plan. This is the plan. The key here for me is complete and accurate daily records so that I can access my trading, review my progress on a month-to-month basis, and make changes in my strategies based on my performance. I also want to incorporate other areas of my life into my trading plan, since trading is a very central and important part of my life. I've shared my actual plan with a number of traders who have come up to the office to trade with me for a week. One of my goals in working with traders is to help them identify the markets and setups and time frames that best suit their personality, and then from there, help them to put together a game plan. The ones who turn the corner and eventually start making a living at this profession learn to stick to their rules. This is typically a painful process. There is only one guarantee I can give you in this business, and it is this. If you can't stick to the rules you develop, and if you are always finding some excuse to enter or exit a trade earlier or later than your rules state, you will never make it as a trader. It is my hope that you will have a better foundation for a plan to trade the markets successfully on a full-time basis. Proven setups to play, markets that best fit that particular setup, and a set of rules to apply to that setup. That is pretty much all a trader needs to survive and thrive in this greatest of professions. I wish you well on your trading journey. This is Patrick Lawler for McGraw-Hill Audio. Thank you for listening. This audiobook is co-published by American Media International, LLC, and Redwood Audiobooks, and is based upon the book entitled Mastering the Trade by John F. Carter, copyrighted in 2006 in the name of McGraw-Hill Incorporated, published by arrangement with the McGraw-Hill Companies, Incorporated. What are